Whenever we have a problem where debt is issued in exchange for services or goods and there's no agreed to um, purchase price or explicit cash price for the transaction, we really need to be diligent from the accounting perspective because we can overstate our assets or understate our assets if we're not careful here. And the FASB has recognized this as an issue, and we have guidance here from our GAAP friends that says, look, if you have a note, and this is what we have here, we have Adams Wood Milling Company that's buying a wood lathe that cuts wood from Blake's Custom Machining Company. They don't have a cash price. If Adam walks in with cash, we don't know what the sale price of the machine is, and that price would be the logical amount that we would book as the value of the asset that Adam's going to put onto his balance sheet. We don't know that because they say the cash market price is unknown. So here's our rule: is we assume that the rate. Okay, so the two parties came to an agreement that this loan, Adam will repay $600,000 in 3 years. He gets the lathe today. He's got to come up with $600,000 in 3 years. Plus, he's got to pay 4% every year at the end of the year on $600,000. And so we assume that this 4% is reasonable, and we would calculate using the present value technique what the value of the equipment is with that method, with using 4% as the discount rate, unless, and here are the rules, no interest rate is stated. That's obviously not the case here. We have an interest rate. We have several interest rates. We'll talk about that. The third thing, I'll skip down to that, the stated face amount of the debt instrument, $600,000, is materially different from the current sales price. We don't know what the current sales price or the fair market value of the lathe is, so we can't use number 3 as either. The second one is what we'll use. The stated rate of interest is unreasonable. How do we know it's unreasonable? You can't just look, if you look at that 4%, that doesn't seem unreasonable given current market conditions, and 4% is not terribly high, it's fairly low, but is it unreasonably low? And the only way we would know is if we do some due diligence here and we say, okay, what other sorts of financing agreements has the company entered into? Or you go out to a lending institution, you can say, hey, you've got a company here and this is about how risky they are, what's the going rate? To lend on a 3-year note. And if we've done our work and we have come up with the understanding that 12% is a much more reasonable rate. Now that tells us that we can't use 4% because a reasonable rate is 12%. You might be thinking, why is this even a problem? Now let me show you why it's a problem. Because if we use 4% or if we use 12% as the discount rate, we get a completely different value for this asset that Adam's going to be putting onto his books as a long-term asset, and then also putting onto his liability section as long-term debt. And we know we follow the present value techniques, which says you come up with the present value of all the cash flows of this agreement, financing agreement. The financing agreement says we'll repay the $600,000 in that's we call the face amount in 3 years, and we're going to have to pay interest at periodic rates. Okay, so the present value is the sum of both cash flows. Okay, so we have to figure out the present value of the face amount and the present value of the interest payment. So let's set it up like this. We know that the future value of the face amount is 600,000. That's 6,000. It's the same regard. Let me just format all of these quickly, otherwise it's going to be somewhat confusing. $600,000 is the face value of the note, given either interest rate that we use to discount it. So this will be the discounted value, this will be the discounted value, and this will be the true value when you add both of those together. And we know the interest payments are going to be, if I could spell it right, the contract says we'll pay 4% of 600 grand. Okay, 4% of 600 grand. And that's annually, pay 24 grand, and we're going to pay that irregardless of which method we use or which interest rate we use as the discount. The contract says 4% of 600,000, so we're going to have to pay 24 grand at the end of each period. That's an ordinary annuity. So we're going to find a factor from the present value tables for the face value and a factor for the annuity. And so I've got the factor tables here. If the factor of present value of $1 at 4%. If we discount using 4%, so this one here, this first line, if we discount the face, the 600 grand at 4% for 3 periods, the factor is 0.889. If instead of using 4%, we use 12%, it's 0.7118. Okay, and that's significant because the present value of the face amount at 4%, sorry, is 533. Now if I do the same thing for the 12%, you can see it's significantly lower. Let's do the same thing for the interest payments. The present value of using 4% as my discount rate at 3 payments, 2.7751. And if I use 12%, the factor is 2.4018. Okay, so the present value of the interest payments using 4% as my discount rate is the 24 grand, the ordinary annuity times the factor. And I do the same thing for the 12%. It's the ordinary annuity times the factor. Okay, so the present value of both of these added together. See how different that is? Now you might not think that's a big deal, but it is, because if we take this rate, we book that asset at 600 grand, and we book the debt at 600 grand. That's overstated because a realistic rate is 12%. So the asset should really be booked at 484,723, and the carrying value of the debt should really be 484,723. So now we can answer the first part of the problem that says prepare the journal entry on January 1st for the purchase of the lathe. So the way we do that is this. I'll just frame it up here. Remember, we're Adams Wood Milling Company, and we're going to get machinery, and we can't overvalue the asset. It's 484,723.20. That's the whole reason we go through these 3 rules. Is it looks like we have an illogical number, or it's overstating the asset. So let me just format these numbers again. That's bothering me that there's not a comma in there. So that machinery goes into the property, plant, equipment. And we said, look, the debt should be reasonably stated at 484,723. That should be the carrying value. The carrying value is made up of 2 things. We have a note payable at its face amount of 600,000, because that's the stated face amount on the note, the contract, but it's a significantly discounted note. So we would have discount on note. And it's the difference between the 2. So the carrying value is the net of those 2. We have a contra liability account. So the debt is now correctly stated at 484,723 when we net those 2 together. And the asset is also correctly stated at 484,723. The concept of conservatism shines through in this problem.